Welcome aboard, everyone. Happy Friday. This is Ilian Yotov, founder of allthingsforex.com and the host of the popular All Things Forex daily broadcast. You can listen to my program on my website, allthingsforex.com. Make sure to also check out my book, The Quarters Theory, The Revolutionary New Foreign Currency Trading Method, available everywhere books are sold. I'd like to thank our friends at fxstreet.com for hosting these series of webinars. And what we're here today to discuss is the final trading week of the month of February, which is going to be a very busy and potentially pivotal trading week, depending on the main event next week and the outcome of it, which is going to be the Italian election. On Sunday, Italian voters are going to take to the polls, and they're going to have 2 days of voting, Sunday and Monday, February 24th and 25th. Now, there hasn't really much been said. I've been reading the financial media, and you would think that there is no election taking place in the third largest economy in the Eurozone. I mean, compared with last year's, everywhere you turned, everyone was writing and talking about the Greek election. Not a lot of things being said about the Italian election. And Italy is only the third largest economy in the Eurozone, as I said earlier. So what does that matter? Well, besides being facetious here, on my program, the All Things Forex broadcast, we have been covering all of the latest polls. We have been covering some of the banking scandals there that have resurfaced in Italy. And although that might be for the most part, at least there have been attempts for things to be covered a little bit, hush-hush, as you may guess, we still see a potential that the outcome of this election may not be as clear as some might anticipate. In other words, we could see the same scenario that we witnessed in the last several years from other countries in the Eurozone, especially in Greece, when neither one of the parties were able to gain the necessary majority. And that led to what's called a hung parliament. So, although it looks like the leader of the Democratic Party, his name is Pierluigi Bersani, is still leading in the polls, the ex-Prime Minister Silvio Berlusconi, who is seeking a fourth term as a prime minister of Italy, despite the scandals and despite of the fact that he was, I think he was being sued to go to jail for 4 years for tax fraud. He is catching up with Pierluigi Bersani and the Democratic Party. The Bene Commune Alliance is the coalition of Berlusconi, center-right coalition, which has been gaining in the polls ahead of the election. But again, you wouldn't know it if you read the financial media, because as I've been speaking on my All Things Forex broadcast, it doesn't seem like the Italian election really is getting a whole lot of coverage, which is quite interesting to me, because that is really a big event next week. And it could be a pivotal election for the future of the euro, especially if there's a change in the political landscape in Italy that could steer the country away from the current course of austerity and reduction of debt loads and so forth, and spending cuts and so forth and so on. The markets are not going to be very excited. And that goes in line with one of our listeners' questions, who says, how's the Italian election going to impact the euro? Well, depending on the outcome of the election, if it leads to a hung parliament, I don't think that that's going to be a euro positive. And the markets are not going to like the risk of Silvio Berlusconi and his center-right coalition coming back to power, because his platform has been on anti-austerity and reversal of some of the spending cuts and reforms that have recently been implemented in the last couple of years in Italy. So this is definitely going to cause a problem, and it could elevate anxiety levels in the markets And of course, that could cause the investor sentiment to deteriorate. We could see more risk aversion. We could see pressures on the euro increasing. And that could be the catalyst for the euro to be pushed even lower than it was today, because today the euro was trading as low as $1.31. Let's see here, $1.31.44. So a little bit below $1.31.5. And yesterday we actually saw a very bearish technical development for the euro. I'm going to switch us over to the daily chart of the euro-dollar pair to show you what I'm referring to. Now, in recent weeks on this program, I have been pointing your attention to that this was a weekly range here that was between an important level in my quarters theory, which is the large quarter point at $1.3250, and some support there that was established at $1.3255 on January the 16th. And then the previous top of that weekly range was $1.34 level, which was, to be exact, $1.3403. A little bit of an overshoot above $1.34. So the euro broke outside of this range, and then it broke above the 2012 high, which was $1.3485. And I explained a few weeks or a month or so ago that if that were to happen, that the euro could gain hundreds of pips more if it were to break above its 2012 high, which it did. 2012 high was $1.3485. The euro broke above it, and it rallied a couple of hundred pips, and it reached a high at the $1.3709 on February 1st. But this was when the European Central Bank and other politicians, including the French president, François Hollande, started talking down the euro, and the French president even went as far as calling for a targeted exchange rate for the euro. And so, at that time on my program, the All Things Forex broadcast, I actually discussed that the euro is joining currency wars. In other words, central bankers in the Eurozone and politicians there are beginning to look for the euro to weaken, to look for the euro, a weaker euro as a tool to stimulate, to spur economic growth, which of course the Eurozone is struggling with, especially after in recent weeks we witnessed a confirmation of what I've been forecasting for at least 6 months, and that is that the Eurozone is going to see 3 consecutive quarters of negative economic growth. And so that's exactly what we saw. The second, third, and the fourth quarter of last year, the Eurozone was actually in recession, a double-dip recession for 3 consecutive quarters. And so, of course, that was a contributing factor for the decline of the euro, but the verbal interventions from the French president, verbal interventions from the European Central Bank president, who also said that the euro exchange rate could be looked at as far as if the euro continued to gain further and it would spark some inflationary pressures and so forth and so on. And so all of these were the sort of statements that we're quite familiar with, because although the G20 may have dismissed the notion of currency wars, despite of the fact that every central banker and politician out there is saying, no, the talk of currency wars is a little bit overblown. I was preparing a presentation yesterday, and I have 4 slides filled with comments from central bankers and politicians around the world talking about weakening their currencies. So, I mean, if you ever doubt that we're in a global currency war, although some may try to deny it or dismiss it, the reality is that we actually are. There's competitive devaluation of currencies taking place. The biggest, most recent example, of course, in recent months is the actions of the Japanese government. But in recent month or so, European leaders are joining with some attempts to weaken the euro verbally. And now the euro the other day was not allowed to rally above $1.34. It looked like it was going to break above that level. It moved as high as $1.34.32. And right away, we got to see a European Central Bank member, Christian Neuer, earlier this week coming out in an interview with Wall Street Journal saying that there's no reason right now the euro to be going higher. There's just no reason for that to be going higher. And of course, when we end up seeing long euro positions being squared away ahead of the Italian election over the weekend. Although, like I said earlier, if you're not looking hard for it, you probably are not going to find anything written about the Italian election. I was having a little bit of fun yesterday on my program, the All Things Forex broadcast, and we went on Bloomberg's homepage, and I love Bloomberg. As I said, yes, I live on Bloomberg, but unfortunately, they have not been covering the Italian election. And so let's have some more fun today and look at the homepage of Bloomberg and see if we can find something that's being discussed there about the Italian election. Top headlines, for example, U.S. stocks rise on German business confidence and earnings. Ben Moore says AIG to build non-U.S. life after asset sales. Bernanke played down asset bubble concern at dealer meeting. KKR said to bid $3.68 billion for pump maker Gardner Denver. Susan Carroll, Morgan Stanley Bank's operating chief, dies at 50. May God rest her soul. S&P probe by Massachusetts said to extend to post-crisis rating. I still am not seeing any headlines about the Italian election. I'll keep going. S&P probe by Massachusetts said to extend the post-crisis ratings. Harvard freshman applications climbed 2.1% to record 35,022. Flawed F-35 fighter too big to kill as Lockheed books 45 states. Ships leaking $37 billion reflect Eisenhower's warning. I'm still not seeing any headlines about the Italian election. That's okay, I'll keep going. Pentagon budget stuck in last century as warfare changes. SEC boosts tally of enforcements with routine actions. Pistorius gets bail before murder trial of girlfriend. Sequestration haircut the painful numbers. Why you want to escape with Denzel? Still nothing about the Italian election. Citigroup's man goes to the Treasury Department. New York's coolest new museum starring Heidi Klum. I laid off my own son, a sequestration story. Delay the cuts, Americans say in a poll. See, I'm not trying to kill time in my program. I'm just trying to make a point. And that is that the Italian election, at least on Bloomberg, and for that matter, in other financial news outlets, is not being covered to the extent that, for example, the Greek election was covered. Why is that? Because Greece is a bigger economy than Italy? I don't think so. So it begs the question, what is going on? Anyway, back to the election. As I said earlier, if the outcome of the election is a clear win of the Democratic Party, which are the leaders in the polls, let me brief you on the Italian election. The Democratic Party of Italy is the leader in a poll. The leader there, Pier Luigi Bersani, is his name. It's expected that they're going to win. However, it is not clear whether they will win with a clear majority in both upper and lower houses of the Italian parliament. And so, if they do not have the clear majority, they are going to have to form a coalition, look for alliances. If they're not able to form a coalition, another election could be called. Remember what happened in Greece? All of that we should be aware of because, as I said earlier, it could create the kind of environment of uncertainty, anxiety levels rising, more risk aversion, more pressure on the euro. So it's not surprising that the euro is coming under pressure. It has, after it sold off from these recent highs, the euro is going through a period of a price correction because the euro's trend's been positive here in the last 6 or so months versus the dollar. And so this is a price correction of this entire move here in recent months for the euro. That's a bullish move. So euro re-entered that range between $1.34 and $1.3250. It lingered within that range for the majority of the last couple of weeks, and just in the last couple of days, starting yesterday, the euro is breaking below the bottom of that weekly range, and it's now obviously extending its losses further. Yesterday, it tried to bounce up towards the previous support level, turned level as a level of resistance now. The euro went as high as $1.3244 yesterday, and then, of course, it's continuing to be under pressure ahead of the elections on Sunday and Monday. So the markets will be reacting to the outcome of these elections. I am expecting that obviously by Monday night we at least are going to have the preliminary results for the outcome of the election, and as I said earlier, depending on whether there is a clear majority winner or not, then that could dictate the future trend direction of the euro. But the bearish breakout is a bearish technical development from a purely technical perspective, and if the Italian election does not have a favorable outcome that improves investor sentiment, or at least does not cause anxiety, then obviously the euro could continue lower on its way to the next important level in my quarters theory, which is the major large quarter point at $1.30. Don't forget, we have an important support level established on January the 4th, which is just a tiny bit below the $1.30 level. Of 4 pips overshoot at the $1.2996, the support level from January 4th of this year. We have a question, as usual. Ron says, it's a pleasure to join your webinars. If you have time, could you look at the maybe pound dollar and your view if in accordance to your quarters theory there is lower level to see than the low we saw yesterday at the $1.5136? Good question. I will cover the pound dollar pair because one of the top 10 spotlight events for next week is actually going to come from the United Kingdom. So good question, Ron. Hang on. I will cover that currency pair in a couple of minutes. The second spotlight event that we're going to watch next week is going to kickstart the sequence of U.S. economic data, and that's the Consumer Confidence Index from the U.S. The consensus forecasts are expecting that the consumer confidence in February will stay positive. A reading of 53.9 is the forecast from 58.6 in the previous month. But I wouldn't be surprised if the risk from now on with the U.S. economic data is to the downside. And the reason I'm saying that is because last week I warned that if we start seeing the U.S. economic data softening, then that is probably going to keep the market's expectations the Fed is not going to tighten monetary policy anytime soon pretty high. So this is despite of what we witnessed in the minutes on Wednesday, that some people interpreted as a signal that the Fed might be considering to reduce the size of the quantitative easing program or start tightening monetary policy sooner rather than later. Now, I don't think that the Fed is going to actually do that at this point, especially if U.S. economic data starts showing signs that things are starting to soften a bit. And the sequence of surprisingly negative, unexpectedly negative reports started with the GDP estimate last month, which showed the U.S. economy, contrary to the expectations, actually contracting in a fourth quarter. Well, next week we're going to have the revised reading for the fourth quarter GDP in the U.S., and we're expecting an upward revision. And as part of the spotlight events later on in the week from the U.S., which I am going to cover, but if the U.S. economic data starts showing signs of softening, and certainly this week the housing starts were a little bit lower, existing home sales were not impressive. What else did we have? We had the Philly Fed manufacturing index dropping by much, much more than expected, contrary to the forecast of a small increase. We saw the U.S. leading indicators increasing, but at a slower pace in the month of January. So there has been a sequence of softer U.S. economic data, and if this now becomes a trend that lasts for a couple of months at least, then the Fed is definitely not going to be in a hurry to start tightening monetary policy anytime soon if they do not see the economy strengthening or recovering. And so I think it's a little bit premature, a little bit early for us to talk about the Fed exiting. And, of course, the future move of the Fed is going to be dependent on the economic data. So that's what I am going to, in the state of the U.S. labor market, most of all. That's why I'm going to watch very closely what the U.S. data shows us throughout next week, because if it is softer than expected, then that will confirm my expectations and possibly the market's expectations that the Fed is not going to be in a hurry to start tightening monetary policy anytime soon. As a matter of fact, the Fed chairman is going to have two speeches, testimonies next week, on Tuesday at 10 a.m. and also on Wednesday at the same time, 10 a.m. Eastern time. So watch these testimonies as well. And by the way, the testimony on Tuesday starts at the same time as the consumer confidence index. So after the minutes report that was sold this Wednesday, a couple of days ago, that was interpreted by some market participants that the Fed might be getting ready to start tightening anytime soon. If the Fed next Tuesday and Wednesday does not confirm such expectations that the Fed is looking at starting to start to tighten monetary policy anytime soon, then that could actually weigh on the U.S. dollar, because if the Fed continues with QE forever or the open-ended quantitative easing program, then obviously that is not going to be very positive for the U.S. dollar. It will be it will be positive, however, for the stock markets if we keep the party going there. So moving forward with the spotlight events, the big event from the UK next week is the revised estimate of the United Kingdom's gross domestic product. And as we covered previously, the United Kingdom's economy, after returning back to growth, it contracted for 3 quarters consecutively. There was a double-dip recession in the UK. Finally, the United Kingdom's economy returned to growth in the 3rd quarter of 2012, and unfortunately, the very next quarter, in the last quarter of 2012, the UK economy once again contracted by 0.3%, according to the preliminary estimate. Now, the revised estimate is also expected to confirm the preliminary reading that the United Kingdom's economy did indeed contract by 0.3% quarter over quarter. What does that mean? It means that the conditions in the UK are taking a turn for the worse again. And after that preliminary GDP estimate last month that showed the economy contracting again in the UK, has been raised odds that there may be a triple-dip recession in the UK. And certainly when you have markets expecting or pricing in the potential for a triple-dip recession in the United Kingdom, that obviously is not going to be a British pound positive. On top of that, the latest minutes from the Bank of England's previous meeting, the minutes came on Wednesday of this week, showed that more policymakers were actually calling for an increase in the size of the asset purchase program, which is the quantitative easing program of the Bank of England. So obviously that was not a shocking, surprising development, simply because if the United Kingdom's economy is indeed facing the threat of a triple-dip recession, whether the Bank of England policymakers like it or not, they would have to consider some further measures to spur economic growth. And, of course, some of the measures there that they have at in their arsenal is to increase the size of the asset purchase program, do more quantitative easing, which is not going to be a British pound positive, obviously. And the minutes also revealed that three policymakers, including the Bank of England Governor Mervyn King, actually voted for an increase of 25 billion pounds of the size of the asset purchase program from 375 billion, the current size, to 400. 6 out of 9 voted against it, so the majority did not agree that there should be expansion of that program. But if more policymakers are calling for more quantitative easing, including the governor, and economic conditions continue to deteriorate in the UK, then the odds are going to increase exponentially that whether they like it or not, the Bank of England might actually do more quantitative easing. Moreover, the minutes on Wednesday also revealed that there was a discussion about the Bank of England actually cutting the interest rate, the benchmark rate, from the record low 0.5%, perhaps by another 25 basis points to 0.25%. So that's on the table again, obviously, the potential for a rate cut. So the threat of a triple-dip recession, the potential for more quantitative easing by the Bank of England, and even a potential interest rate cut in the near future, all of that coupled with more risk aversion is, as I said earlier this week on my All Things Forex broadcast, could become the formula for further British pound weakness. And so, no surprise to see the pound-dollar pair actually in a pretty much a free fall here in the last couple of weeks. And the important, most interesting development when it comes to the pound-dollar pair is that we now have a very bearish breakout, and it's not just a regular breakout below some regular support level. This is a multi-year low that the pound broke yesterday. And although it spiked a little bit higher and it's now retracing to previous support levels there to test them as levels of resistance, which all of them are sort of around the important level in my quarter theory, which is $1.5250, large quarter point. Make no mistake, this is not a coincidence. $1.5250 area of the large quarter point has been serving as a level of support since July or August of 2010. Now, I know that many traders don't really have that kind of a span. I think that most currency traders, at least retail forex traders, are focused on where the next 10 or 20 pips is going to come from. But that's one of the differences in my outlook. And if you listen to my All Things Forex program or these weekly webinars, you should know that I'm not generally focused on where the next 10 or 20 pips is going to come from, but I have usually a much broader perspective. And so when we go back to 2010, and I don't have time to just move these charts and so forth and so on, so you can look it up yourself, you will see that since the summer or the fall of 2010, the $1.5250 area and that previous support level, which was $1.5232, has not been broken below. And the pound-dollar pair exchange rate, as I've been saying for years, has been stuck within a range. It was basically trendless and stuck in a range of about 1,100 pips, give or take, between the large quarter point area of $1.5250 and $1.63, which the area expanded a little bit more with the recent highs that were reached at a little bit above $1.63 at the $1.6341. So that gives you approximately about 1,100 pips of a range. And all that the pound-dollar pair has done since pretty much the summer, fall of 2010 is fluctuate within that range. Goes up to around $1.63, then it goes down to around $1.52.5 area, then goes back up again to $1.63, and now the most recent move is the move lower, back to the bottom of the range. But the significant development from the last couple of days is that the pound-dollar pair is actually breaking, for the first time in 2 years, that support area, the bottom of this range, which is, in my opinion, a bearish technical development. And if the pound continues to have troubles as far as, I mean, obviously it's due for some price correction here. I think that the sell-off was very extended. The pound's pretty much been in a free fall for 1, 2, 3, 4, 5, 6, 7, 8, 9 trading sessions. So in my book, that's way overextended of a type of a, what I call a bearish trend wave. So it's very extended, and the pound obviously was due for some correction of its losses versus the dollar. But after this correction is over with, I think that if the GDP next week is not revised higher, which the consensus forecasts are not anticipating that to happen, and if other UK economic data continues to show that conditions deteriorating in the UK economy, then obviously that could weigh on the pound. And if that is coupled with more risk aversion and anxiety that could be triggered by the outcome of the Italian election, and have the formula for weaker pound versus the dollar. And we could possibly see the pound extending its losses further into that new large quarter that was began to be worked on in the last couple of days. Because in terms of my quarter steer methodology, I propose that prices do not fluctuate randomly, but rather in an organized manner, and that they fluctuate within the what I call the large quarter points of each 1,000 pip range, which in this case, the pound-dollar pair is in the 1,000 pip range between $1.50 and $1.60. In terms of price interest points or pips, that's exactly a 10 cents range. In terms of price interest points, that's 1,000 pips. I divide with my quarters theory these 1,000 pip ranges into 4 equal parts, or 4 large quarters of 250 pips each, and I propose that the exchange rates fluctuate and prices in general fluctuate in an organized manner in an effort to complete these large quarters with moves from one large quarter point to another large quarter point, targeting another large quarter point. And then ultimately, when they complete the 4 quarters of each 1,000 pip range, they complete the entire 1,000 pip ranges. And that's what the pound-dollar pair could do if it manages to complete this final quarter of the $1.50s, because obviously it's a bearish trend. It's a move to the downside for the pound versus the dollar. So the pound's been working on completing the 1,000 pip range, falling from $1.60 down towards the $1.50 level. And if next week we get to see the factors that I explained earlier continuing to weigh on the British pound, we could potentially see further progression of the pound-dollar exchange rate into the final large quarter of this 1,000 pip range, which is going to be the quarter between $1.50 and $2.50. Of course, with the pound falling below $1.52.50, it started working on a quarter to $1.50. A little price correction now here. A little bit of a bounce higher, and if the pound drops again next week below $1.52.50, and then it challenges the support level from yesterday at the $1.51.30, and it breaks below that level, and $1.51.30, by the way, don't think that this is a coincidental number. In my quarters theory, there is nothing coincidental, and that's the beauty of it. It challenges the notion of chaos and randomness that most traders are actually accustomed to, or they're trained to think that the markets are completely random and chaotic. And I challenge that notion with my quarters theory by creating a familiar and predictable environment in which a trader can recognize instantly what the direction of the current move is, what is the effort there, and ultimately monitor some important price levels to recognize signs of strength or weaknesses and base its decisions depending on those signs. So I think that after the correction is over with here, after the extended 9 days, overextended 9 days sell-off of the British pound, I think that there is a potential for that trend to continue lower. To answer the question from our listener, he says, do you think that there may be a lower level to be than the low from yesterday at the $1.51.36 or $1.51.30, which is my quote? I would say yes, the potential is definitely there. If, of course, the current the underlying fundamentals continue to be supportive for further British pound weakness. In other words, if the economic data continues to show signs of weakness from the UK economy, if there's more risk aversion next week, and from a purely technical perspective, if we get to see a bearish breakout below $1.5130, I think that we could quickly see the pound-dollar exchange rate targeting the major large quarter point at $1.50. And that could happen sometime next week if all of these factors come together and weigh on the British pound. Going forward with the top 10 spotlight events of the week. On Wednesday, we're also going to pay attention to the U.S. durable goods orders. The big decline is expected there, so add that to the list of softer economic data from the U.S. I am keeping a score, by the way, as I said earlier, especially after the recent few weeks. We've seen some surprisingly negative reports from the U.S., which are raising a bit of a red flag for me. The January durable goods orders are expected to drop by 4.4% month over month after increasing by 4.3% month over month. So as I said earlier, we'll add that to the list. Pending home sales are due also at 10 a.m. Eastern Time on Wednesday. They're expected to show a slight increase by 1.7% month over month after pending home sales dropped by 4.3% month over month in the month of December. It's a gauge of housing market activity, and the housing market data has been rather mixed, as we witnessed, and had some weak undertones, actually. The existing home sales, without risking to get into too much details, existing home sales were at 4.95 or 4.94 in December. But that number was revised lower with the report that came yesterday. That number was revised to 4.9 from 4.94. And so, because they were revised lower, existing home sales were at 4.92 in January, so they would have been lower than the previous month. But because the previous months were revised lower, for January they were a little bit higher. But that doesn't mean that they're not going to be revised lower in February, the numbers for January. And then the housing starts were lower. And the pending home sales could show pending home contracts increasing by 1.7% month over month. But again, if there's another disappointment there, we'll add that report to the list of negative, surprisingly negative data from the U.S. What is now expected to be very negative is the Swiss gross domestic product, and I have included that report in the list of top 10 events because that is important report to watch, because the Eurozone, which was in 3/4 of a recession, in the fourth quarter, the Eurozone contracted by even more than expected. And the Eurozone is the largest trading partner of Switzerland. So obviously, conditions in the Euro area directly affect Swiss economic conditions. And so the Swiss economy managed to grow by 0.6% quarter over quarter in the third quarter of last year, but is now expected to be flat, to show 0% economic growth in the fourth quarter. And more than likely, that's going to be due to the effects of the contraction in the Euro area. And there has been contraction, by the way, in the fourth quarter of 2012 in all of the 34 countries members of the Organization of Economic Cooperation and Development. In case you're wondering if the global economy, major economies around the world are doing well, the answer is they did not do well in the fourth quarter of 2012. All of the major economies, the United States, Japan, Germany, France, Italy, all of them contracted in the fourth quarter of 2012. Well, the U.S. numbers, as you can see in a minute, are probably going to be revised higher, so we may not have contracted in the fourth quarter, but the others did. And now it wouldn't be surprising if the Swiss GDP numbers are impacted by that. And so the forecast is from 0.6% growth in the third quarter for the Swiss economy to show flat readings, 0% economic growth in the fourth quarter. At least it's not a contraction, but it's no growth in the fourth quarter. that could send a signal to the Swiss officials, especially the Swiss National Bank officials, that, as they have been saying all along, the Swiss franc is still significantly overvalued versus other currencies, such as the euro. And although in recent couple of months the euro has strengthened versus the Swiss franc, perhaps the GDP report could serve as a reminder that the Swissy is still very strong, according, when it compared to its long-term averages. And could this prompt some sort of verbal interventions or maybe even actions to weaken the Swiss franc in an environment where we have a global currency war taking place? I would not exclude the possibility of that. So that is why I included the Swiss Gross Domestic Product Report in the events that we should watch next week. This report is going to be followed by the U.S. second revised estimate of the U.S. GDP for the fourth quarter. And as I said earlier, the expectations are that the U.S. is going to actually grow by 0.5% quarter-over-quarter, or quarter-over-year rather, in the fourth quarter of 2012. Now that, of course, will be an upward revision because the preliminary estimates showed an expected contraction by 0.1%. So needless to say, that would be a little bit of a more positive, upbeat report. But if there isn't an upward revision, then that's going to confirm the market's concerns about the state of the U.S. economy and perhaps conditions taking a turn for the worse. And make no mistake, even if we get to see that upward revision to show the economy growing by 0.5% instead of contraction by 0.1%, if you compare this type of anemic 0.5% growth with the growth that we have witnessed in the U.S. economy, which was as high as 3% in the third quarter, then you can definitely see the signs of a significant slowdown in the U.S. economy. So, but for all it's worth, an upward revision could actually perhaps instill some optimism there that at least we're not contracting here in the U.S., which is the world's largest economy. On Thursday night, we'll pay attention to an important gauge of inflation coming from Japan, preferred by the Bank of Japan, of course, the Consumer Price Index. As you may recall, in recent months, the Bank of Japan caved into political pressure, and exactly as requested by the new Prime Minister Abe in Japan, the Bank of Japan moved its inflation target from 1% to 2%, and also committed to their version of QE forever, similar to the Fed, an open-ended quantitative easing program, which is going to continue. The Bank of Japan said they will continue with aggressive quantitative easing until the 2% inflation target is in sight. So, this is why we're going to watch the Consumer Price Index, and in particular the National Core Consumer Price Index, which is the preferred gauge of inflation by the Bank of Japan. What we want to see is whether or not inflation is getting close to 2%, the desired target level by the Bank of Japan, which is also going to signal the end of their open-ended quantitative easing. Unfortunately, for those who are expecting the end of that quantitative easing, the end is nowhere near in sight because the National Core Consumer Price Index in Japan is expected to stay at minus 0.2%, and that's year over year. Now, at minus 0.2%, we are pretty far from the 2% target, and we are actually in deflation territory. Hence, the Bank of Japan could be forced to continue with their aggressive policies to weaken the Japanese yen, to fight deflation, and to create economic growth. In other words, if there's no surprises with the Consumer Price Index rising in Japan, then the market's expectations that the Bank of Japan will continue further with aggressive monetary policy easing are going to stay there, and the Japanese yen could stay under pressure. Now, I have spent plenty of time in recent weeks showing you the examples of what I call an overextended bullish trend wave sequence. And I've referred to the example that I've given you in my book of my version of the classic Elliott wave theory. And in my book, The Quarters Theory, I gave an example of 7 consecutive bullish waves and bearish waves as well, following each other. So this is a very interesting example here, what's happening in the recent months with the dollar-yen currency pair, and I'm showing you the daily chart of the dollar-yen pair, because not only have we seen another example of an overextended trend wave sequence of 7 waves, but actually last week we saw an attempt for the dollar-yen pair to build another 8 consecutive bullish wave. Now, what I explained in detail last Friday that we should watch this week was whether or not this 8 bullish wave is going to be successful. In my book, The Quarters Theory, if you bother to take a look at it for yourself, which I would definitely recommend, you will find out more details about my version of the classic Elliott wave theory. And I warned that if you can read, it's readable. One of our listeners says, is it readable for beginners? Yeah, if you can read, yes, it is readable. Anyway, but yeah, check it out. Buy my book. Check it out for yourself. How's that for a direct plug-in? Anyway, last Friday I explained in a lot of details that if one was looking, and there was a great question from one of our participants last week's webinar, saying, okay, what would be the early warning signal that the price correction that I've been calling for in recent weeks is finally going to take place? And I explained in detail what would be the first signal that more significant price correction, and I don't mean by that the corrections following each one of these bullish trend waves, because each one of those waves comes to an end, goes through a period of a correction for a couple of days, and then the trend simply continues further until we got to 7 bullish waves, and then an 8th one starting last week. So I explained, in order for that more significant price correction to occur, we're going to have to see that bullish trend coming to an end. And it's really not a rocket science if you actually bother to remember what the basic definition of an up and down trend is, which a lot of traders who know how to read spaghetti charts and the latest and the greatest technical indicators, believe it or not, a significant portion of such traders don't even know what the definition of an up or down trend is. But, of course, if one knows that higher highs and higher lows is the definition of an uptrend, then once this currency pair stops producing those higher highs and higher lows, we will know that this trend is over. Also, as I explained in my book, The Quarters Theory, the concept of trend wave failure is something that a trader should know, because it's a very helpful tool as far as preparing for an actual reversal. And what I explained last Friday is that if this 8 bullish wave on the dollar-yen daily chart were to fail, if in case you're wondering, this is different than the classic Elliott waves, because I actually give the actual trend waves a number, and I don't give a number, and I don't call waves the actual retracements. So that really helps with the proper wave count, which is the biggest challenge of any Elliott wave trader. Proper wave count. In other words, if you can't figure out what number of waves you're trading, then you could be at the end, the final phase of the trend progression, rather than in the first early stages of it. And of course, if you're coming in too late, you're always risking to become a victim of the price correction that could follow in a move against you. So, just so that in case some of you are Elliott wave traders out there and you're scratching your heads and you're saying, how did this guy count 8 waves? Well, let me elaborate on that. Here's this was a bullish trend wave, and we had a little bit of a price correction, but here we had a little bit of a reversal wave, so that zeroes the counter, so to say. And so we start off again with a fresh new sequence right here, which is your first bullish wave. This is the correction following the first bullish wave. This is the second bullish wave, and this is the correction following the second bullish wave. this is the third bullish wave, and this is correction number 3 following the third bullish wave. This is bullish wave number 4, and this is the correction following bullish wave number 4. Note here that the biggest difference between the classic Elliott wave theory and my version of it is that I don't limit the number of waves in a trend wave cycle. In other words, the trend wave sequence doesn't have to stop after 3 waves in the same direction, which is in a classic example. Here we have a 4th bullish wave, correction following it, 5th bullish wave, correction following it, 6th bullish wave, correction following it, 7th bullish wave, correction following the 7th, 8th bullish wave, and what did I warn about last Friday? Watch to see if this week the dollar-yen pair will break above 94.44, which is the high of the 7th bullish wave. If there was a higher high than 94.44, then we would know that the 8th bullish wave is successful. This week, the highest we've got was 94.20. Is that a higher high? No, it is not. So we're starting to see the first signs that the 8th bullish wave may have failed here. And as I explained last week, in most instances, as a result of a trend wave failure, we can anticipate the development of what I call a reversal trigger wave in the opposite direction. In other words, we could see now a reversal trigger bearish wave in the opposite direction of this overextended 8 bullish trend wave sequence. And the contributing factor, the trigger for that reversal wave, is going to be the failure of the 8 bullish wave, the inability to continue that bullish trend wave sequence with another bullish wave. So that's also what we're going to watch for next week, or at least I'm going to watch for next week. And the way that we will know that such reversal trigger bearish wave is developing is if the dollar-yen pair drops below recent lows at 92.21, which was the low of the correction, following the 7th bullish wave. So that will give us the confirmation. A number below 92.21 is going to give us the confirmation that we're witnessing what I call a reversal trigger wave in the opposite direction of the 8 bullish trend wave pattern, which is going to be a corrective bearish trend wave pattern of 1 or 2 or maybe even 3 waves, as many waves as the market decides to go with. And during such corrective trend wave pattern, as I said earlier, I wouldn't be surprised if the dollar-yen pair does go towards the challenging, at least the 90 yen area. There was a previous resistance over here at a little bit above 90 at 90.23 yen, the high from January 21st. That's an area that I think that a more significant price correction, a bearish trend wave, corrective bearish trend wave pattern is probably going to take the dollar-yen exchange rate too. Now, if it breaks below 90 yen, the correction could extend even further to about 88 or so, 88 and a half. But at first, we need to really focus on whether or not next week we'll get the confirmation that there is a reversal trigger wave finally establishing for the first time, a reversal trigger wave establishing since, what was it, December of last year. So the bullish trend is still intact, but I think that the dollar has been long overdue to correct some of these gains versus the Japanese yen, and a reversal bearish wave pattern is going to give the opportunity for such more significant price correction to actually occur for the dollar against the yen. But if the correction occurs before Thursday night, watch for the yen to stay under pressure after the CPI report, because obviously the consumer price index and the inflation gauge in Japan is not expected to get any closer to the desired 2% target level for inflation by the Bank of Japan. So as long as that 2% target for inflation is not in sight, the Bank of Japan is more than likely going to continue with their aggressive monetary policy easing. Next Friday, we'll be watching the Purchasing Managers Index as well from the manufacturing sector in the Eurozone. Yesterday, disappointment from the Composite Purchasing Managers Index, which came lower than expected and stayed for an entire year now. The Composite Purchasing Managers Index, which is a combination of activity in the manufacturing and services sectors in the Eurozone has stayed below 50, which is in contraction territory for an entire year. And so it will be interesting to see what the Friday's final reading for the Manufacturing Purchasing Managers Index show us. More than likely, it's going to show us that there is a chronic contraction, as I've been calling it all along, in the Eurozone manufacturing sector. There's also a chronic contraction in the services sector, and there's 3 consecutive quarters of negative economic growth. So the current conditions in the Euro area are not very promising. There were some forward-looking indexes, the ZEW index, which is sort of a forward-looking index for the conditions in the next 6 months or so. ZEW index was better than expected earlier this week. This morning we saw the IFO index also coming up better than expected for Germany Business Climate Index, moving from 104.3 in January to 107.4 in February. Again, these are forward-looking indexes. The current conditions are not looking good. The forward-looking indexes are showing some signs of potential improvement, but the Italian election is weighing on the euro, and if it continues to do that next week, I don't think that the euro can find a whole lot of support if the outcome of the Italian election is not very positive, and if the Eurozone economic data throughout next week is not does not instill any confidence that conditions are improving. In the United States, the final of the top 10 events is going to be the ISM Manufacturing Index next Friday, and that index is expected to show a small pullback from, let's see here, from 53.1 to 52.5 in the month of January. So we can add that report to the list of softer economic data from the United States. Well, this is all the time I have for today's program. Before I finish, I'd like to invite you to listen to my daily All Things Forex broadcast and live analysis of the currency markets Monday through Friday and on my website, allthingsforex.com. You can also follow us on Twitter at allthingsforex is the Twitter account. I'd like to thank you for your participation in the broadcast and in our program today, and for the good questions. Have a great afternoon and a great weekend, and I will see you again next Friday.